Good morning. It is Monday, October 16th, 2023. It's just before 9 a.m. on the East Coast. This is Rob Sin at CEO Technician on Twitter, at Goldfinger on CEO.ca. And once again, a lot to get to in this video. I'm doing it on a Monday morning, so it's going to be slightly abbreviated. Definitely want to start with gold and what happened in gold last week. Starting out with this tweet I made Friday afternoon after the market closed. Gold ended the week above 1940, up nearly $100 per ounce for the week. And you can see in this chart how powerful of a reversal gold has made in the last few weeks. Recall a Fed meeting, a Fed announcement, Powell press conference September 20th. Gold traded up near 1970 at the high of the day and then proceeded to tumble over the next 2.5 weeks. So going from 1969 to 1823 in pretty much a straight line down. But then 2 Fridays ago, something changed. Yield started to back off. Over the next 24 hours, we would learn of the terror attacks in Israel, and the rest is history. Gold had an incredible week last week, opening with an opening gap higher to 1857.50, and then climbing all the way till the closing print for the week, 1941.50. It's also interesting that this tweet received a lot of attention. You can see the views, almost 100,000 views. So the reversal obviously got a lot of people's attention, and the potential for the fact that this was just a failed breakdown, that gold made this pennant over many, many months, proceeded to break down from the pennant and break down far enough that surely if you were long somewhere up in here, you got stopped out from any trade, any long gold trade. But the longer term uptrend, as characterized by the 200-week moving average, remained intact and fully intact, and it didn't actually even touch that 200-week moving average. It stopped just short of it, and now we're back into this sort of pennant pattern. So very notable action in gold the last few weeks. Now go back to this monthly chart. So this is something I talked about back in like June or July, the triple top interpretation in gold. Is it a triple top? Just having a little coffee here. Certainly 2 weeks ago, when gold was breaking under 1850, it was looking more probable that that interpretation might come to be. But after the powerful reversal that we had last week, now we're back above this blue line that I drew. The blue line is essentially 1900. As long as gold is above 1900, I have to err on the side of this is a bullish consolidation, marking time, building energy for an eventual thrust back to test that area of resistance around 2080 an ounce. So the month is not over. Still a couple weeks here left in October, but the fact that gold has managed to pull back more than $250 an ounce from the May peak at 2085, and do that while largely going sideways. Obviously, there's been some lower, but largely going sideways. Not from where we stand today, the correction off the May peak is not, um, it's not unusual. Okay, gold regularly will pull back 5 to 10%, and then continue higher in the longer term secular trend. So that seems to be what's taking place here. And, the correction down to 1820s is just classic stuff where a lot of people would have capitulated. A lot of sell stops would have been hit down there on that move lower, and then a very violent move back up. Um, I do want to sort of talk about, okay, so what could explain last week's move in gold? And there's the obvious, oh, it was a flight to safety because of war and terrorism in Israel. Certainly, that could definitely play a part in what gold did last week. Um, this morning, gold is pulling back about $10 an ounce in futures trading. And whatever, over the weekend, there are a lot of things being said, a lot of reports being thrown around. But the best I understand it as of now is that Israel has not officially launched a ground invasion into Gaza, and Hezbollah has not officially joined the conflict with Israel. And President Biden may even be visiting Israel later this week. So somehow it seems unlikely that a sitting, U.S. president is going to visit during a time of all-out war. It seems like maybe some cooler heads are starting to prevail there. And maybe that could explain also why gold dipped $10, because there wasn't a big escalation over the weekend. But then on the flip side of that, well, look at oil. Oil's basically flat. You know, I mean, it's basically trading near where it ended on Friday. So, we would think, well, if oil spiked 5% on Friday on fears from the Middle East, then why isn't it coming back in if there are some appearances that maybe cooler heads are prevailing? Just questions. I don't have the answers for them, but I think there was probably a little bit more to the gold move on Friday. And one of the things that might have contributed to it is this speech from Philly Fed President Patrick Harker. I'm not going to read the whole thing to you, but the key points are this: absent a stark turn in what I see in the data and hear from contacts, both in one-on-one conversations and in forums like this, I believe we're at the point where we can hold rates where they are. Yeah, he said a lot, but that's the gist of it. He is applauding the disinflationary trend, and he believes that there's still more effects coming from the Fed's tightening that have not fully made their way through the real economy, the long and variable lags. So he believes the tightening is working and continues to work, and he's no longer so worried about inflation. Okay, and he emphasized that core PCE inflation is showing clear signs of progress, and he expects to see inflation drop below 3% in 2024. So Harker very clearly says he's on hold. Now, if we look at Fed funds futures, the odds of a November rate hike are down to about 5% right now. So almost zero. And, as I've said several times in recent videos, as we enter 2024, it's just going to be harder for the Fed to do anything drastic in terms of monetary policy. It'll be harder for them to hike because it will give the appearances of weighing on the economy at a time when Americans are especially sensitive and going out to vote. And, you know, it's too soon to be calling for a rate cut, considering the Fed is not at its 2% mandate level, right? And the labor market, at least according to the government stats, is not showing many signs of weakening. So you would only expect a rate cut when the Fed was clearly overshooting on its inflation target to the downside. So we were getting very low inflation readings, or the labor market was weakening significantly and unemployment was trending higher. So neither of those is happening now. So rate cut is not even in the conversation. So it just continues to support the idea that the Fed is on hold now. And the Fed is probably going to be on hold for at least another 6 months, well into Q2 of next year. And then we'll see how the economy is playing out. Another interesting thing about gold, a lot of you who follow me on Twitter or CEO.ca know that I posted this research from Myrmikan, Daniel Oliver of Myrmikan Capital, called On the Other Hand, and really excellent read, very thoughtful commentary here by Mr. Oliver. And he continues to pound the table. The Fed is trapped. It has trapped itself. And we are cruising towards a major financial calamity very soon. And the fact the Fed has been doing so much QE in recent years has really created major distortions in financial markets, including in the Treasury market. And there's probably going to have to be more interventions from policymakers in government debt markets over the coming years. And I really like the way he finished it. Empires are not felled by a single failure or even a series. They collapse when faced with multiple systemic disruptions, especially if their reserves have been expended on previous emergencies. The U.S. spent its capital reserves on bailing out the banks in 2008, its economic reserves on the COVID hysteria, and its military reserves in Ukraine. Its enemies know that the American empire is vulnerable. Um, he's maybe a little hyperbolic here, but the point is well taken. Can you just imagine how much money and human capital effort was wasted during the COVID pandemic hysteria? And how about all the damage that we did to our environment by producing all those, disposable masks and plastic gloves and God knows what. Oh man, yes, a lot of waste. And yeah, the U.S. has supplied, Ukraine with a tremendous amount of armament, such that it actually is taking away from what we have at our disposal, should we be attacked as a nation. And then he finishes with the collapse of the financial system that has been in place since 1980 is long overdue. Gold investors are the bond bulls of 1980. So basically, we've been kicking the can for 40, 50, 60 years. The government's been kicking the can. The Fed's been kicking the can. And it's impossible to predict the exact timing or what the straw will be that will finally break the camel's back, but it's coming. It's coming. Just like 1929 stock market crash, there's no point in assigning any particular cause for the collapse of the market at that time. It was just overdue, and it was long, long overdue. Okay. And so just a lot of food for thought there. And some of it is kind of scary when you think about it deeply. But yeah, the point is well taken. We all like to attribute an event to why the market did something, and it's not always like that. At the end of the day, the market can move. A market, a stock, a futures market, a precious metal can move just simply because buyers woke up one day and were a lot more eager to buy that thing than they were the day before. And sellers were more reluctant to sell it than they were the day before. The offer prices move up, the bid levels move up, and the market moves up, right? Now, yeah, but what was the motivation? What caused the buyers to wake up and want to buy it more? Yeah, okay, so that's something to think about. But there could be a lot of reasons why. Could be a lot of reasons why. Um, Gold. This was published in the Globe and Mail 2 Fridays ago. So October 6th was actually the day that gold tagged 1823.50. And it's so I don't subscribe to the Globe and Mail, so you can't see the whole article here, but it's called "The Case for Leaving Gold in the Ground." We already have plenty of this precious metal for its practical uses, yet we pay a healthy environmental and social price to extract more. Could we agree that enough is enough? And just, oh, Canada, can gold mining is a big industry in Canada. It supplies a lot of jobs to the Canadian economy, a lot of high paying jobs to the Canadian economy. Uh, it brings in wealth and investment to the country. And frankly, Canada, the country, does not have any gold reserves in its treasury. Canada sold all of its gold a long time ago at a much, much lower price. So there's a lot of things I could say about this article, but I would just say, hey, how about continuing to support your economy and teach young people how to be mining engineers and geologists and work hard to earn a good living, just like people have always done in Canada. And maybe take some of that gold that these companies are working so hard to extract from the ground and buy it from them and put it in the national vaults, national gold reserves, so that the country is not completely broke and you have some hard, sound money uh, at your disposal, right? So Canada, there's a lot of things that make my eyes roll here in the US about our administration right now, but Canada really takes the cake sometimes. Um, Gold, shorter term technical. So this is the daily chart, daily futures chart. And I have a little secret to tell you guys, okay? Uh, Notice this trend line. This is a very powerful trend line. A lot of confluence near this 1940 area. Okay, a lot of confluence came in there uh, at Friday's high, Friday afternoon, and then even last night when the Sunday futures opened, got as high as 1943. So this is a resistance level. Gold ran into resistance there at 1943. I actually took a short trade on gold. Don't worry, I've covered it already. It was a shorter term tactical trade. It worked. Not for the faint at heart, because a lot of bad things could happen at any moment in the world, and gold could spike even higher, right? But when the best setups, the highest probability setups come about, as a trader, you just have to take them and manage your risk accordingly. So this is the nut to crack right now. I would say 1943 is the immediate level of key resistance in gold. And then I would go back to this September 20th day, 1969. So if we can break the series of lower highs, if we can break above this lower high, that would be a major confirmation of a trend change in gold to the upside. Okay. Uh, I do not think the triple top interpretation is appropriate still. I don't think it's a triple top. I think the odds continue to favor a bullish continuation pattern, and I cannot predict when that breakout above 2100 takes place. It could be by the end of this year, or it could be, uh, 6, 8 months from now. Gold is tricky like that, right? And I didn't guess that gold would dump to 1820 and then U-turn immediately back above 1900, almost to 1950. I don't think anybody predicted that. And if you did, show me your trade confirmations of how you traded it so well. A lot of people talk about things, but they don't actually do them. So turning to stocks, E-mini S&Ps, we're trading up this morning. So that's another thing. So as I was saying, it seems like cooler heads are prevailing in the Middle East. That could explain why gold is down 10, 12 bucks in futures trading, but it also helps to explain why S&P futures are trading up about 20 points here this morning. For me, the E-mini S&P has been a great trading vehicle the last month. A lot of two-way action, a lot of volatility in a wider range. We got up to about 44.30 last Thursday morning, and then had a very sharp decline during Thursday session, and then another sharp drop off the open Friday morning. So there's a seems to be a little bit of a theme forming here, where the futures, the overnight futures trading, the E-mini S&Ps climb higher in the overnight futures trading, and then when the U.S. opens, the cash market is trading, they get sold off a bit. So we'll have to watch to see if that trend continues. Some levels that I'm looking at on my charts of 43.69, now a downside support level. Underneath that, this 43.54.50 area, definitely some support there. And then a much bigger zone, I'll call it a zone, down between, let's say, 43.35 and 43.40. So Friday's low was 43, let's see, 43.40. Yeah, 43.40.75. And then on the upside, I mean, it's pretty simple. We have this 4,400 level, definitely a big level there. And then above that, probably up to about 44.20 to 44.25. Yeah. And so we're, as long as we stay constrained, between, let's say, 43.50 and 44.25, it's a range bound volatile trade, but the market's not really going anywhere. It's not showing us any real trend. Okay. It's just continued to be this dicey range. And it makes sense because a lot of investors, the market is seeking clarity on a lot of things going on in the world right now. So it would make sense that stocks would trade in a messy range. And actually, if you go to the SPY daily chart, we're definitely getting like this moving average squeeze where price is under a downward sloping 50-day moving average and it's above an upward sloping 200-day. And so this kind of a setup on the daily chart is characteristic of a range bound market that is seeking direction. Okay. And we don't know when we're going to get that. It could be tomorrow. It could be a month from now. QQQ, you could draw a little trend line off of these tops and it would line up perfectly with Thursday's peak in the QQQ. So lower series of lower highs is intact here, and I wouldn't be surprised if we had to test lower and hammer in place a higher low in the Nasdaq 100. We are entering earnings season, so a lot of the big mega cap names, the mega cap tech names like Amazon, Apple, NVIDIA, Microsoft, Meta, they'll be reporting over the next several weeks. So that'll give us a lot of information, and probably at some point during this earnings season, we will see a trend take hold in uh, mega cap tech stocks. So precious metals, we talked about gold. Silver, also very similar situation to gold, where like a failed breakdown, right? We broke through that $22 support level, even dipped under 21 very briefly there in early October, and now we snap right back to sort of the middle of the recent range. This is not something you chase on big rallies. Clearly, 23 is a big, resistance level, and so far that seems to have contained this move to the upside. Silver is just inflicting pain upon short-term traders, with this volatility and the whipsaw movements. But pull it out to a longer-term weekly chart. So let's make it like a 5-year. And let's see what it looks like, right? It's a big consolidation. You could even say silver might even be forming a head and shoulders bottom. Here's the shoulder, here's the head, here's the shoulder. Possible. It's possible. Certainly, a lot of energy has been built up here the last few years in silver. And I think the level that everybody's really looking at is $30. Like that's really the big upside level. Obviously, if it got back above 27, that would get a lot of people excited because that would be a new 52-week high for silver. But really, the big long-term level is that $30 breakout level. And support, I mean, clearly 21 is a support level, and then 20 is an even bigger one. It's not very hard to be able to pick these big technical levels on the silver chart. They do line up with round numbers, quite frankly. Gold miners, GDX. So we got really oversold first week of October, and now we're up 6 of the last 7 days for the gold miners. $30 is the big resistance level in GDX. That's the big upside level. I would not be surprised to see some cooling off here in the GDX chart this week, maybe a little sideways to a lower action in the $28 to $29 range. And that would actually be really healthy. Build more of a base from which to stage a end of year rally from. That's what I'd be looking for in the GDX yield. So yields have moderated. This is also helps to explain why gold and silver have had a big move up in the last week. Clearly, there is a negative correlation. Higher treasury yields, lower gold price. That's been a very strong correlation this year, and I expect it to continue to be, quite frankly. Euro USD, this is still in a pretty powerful downtrend. It got a little snapback, but a pretty weak bounce if you ask me. And the fact that dollar is so strong is not a very favorable sign for the broader stock market. Okay, I think that this is a pretty big headwind for stocks, and the fact that the dollar was up on Friday and gold was up over $50 an ounce just tells you how powerful that the fund flows that moved into gold last week really were. Okay, so this is something to not ignore. Gold had a very, very powerful move last week, especially on Friday. And even though gold is pulling back a little bit here this morning, that money that went into gold on Friday is not leaving yet. Okay. And we have to watch and see if there's more inflows where that came from. Definitely a break of this trend line above 1943 would be strong evidence of that. Just some individual stock charts. So, NVIDIA, obviously one of the mega cap tech leaders, darlings. And look at the consolidation on the weekly chart. So some people are trying to paint this as this is a bearish pattern. No, I mean, this is a bullish consolidation pattern. Some people might want to call it a diamond top. Let's see how it resolves. I mean, break down under 400 or break out above 500. And I bet you that we're going to see a move like that here in the next month as earnings season gets underway. And, NVIDIA will report its Q3 earnings. ExxonMobil. So this is definitely one of the most volatile mega cap tech oil stocks out there. Look at how wild the trading has been here in the last month in Exxon, from 121 down to 105 and closing at 110 on Friday. Pretty wild action. I don't really have much to add there, but this kind of looks like a important top. With the force, the violent downward thrust it had off of that late September peak. I wonder if that's a sign that oil is peaking here near term. Caterpillar, definitely one of my leading indicators of stocks that I look for to determine the health of the overall market. It's also consolidating in a largely sideways range, but there are definitely a lot of red candlesticks here the last few months. And look at these wicks, the upper wicks on a lot of these candles. Series of lower highs and lower lows are in place here. So Caterpillar starting to feel like it's guilty until proven innocent. But this stock has a knack of finding bid support when it needs to, but definitely one to watch. The chart has turned significantly more bearish in the last couple weeks for Caterpillar. Freeport-McMoRan, I could say the exact same thing here. This is now in a pronounced downtrend the last 3 months, from $44 a share to $35 a share. A lot of red candlesticks in the last 3 months, and obviously a very clear trend: lower highs, lower lows. 50-day moving average is sloping downward, and price is under the 50-day. So, the more we look underneath the surface of this market, the less healthy it looks. A lot of warning signs here for sure that the market's health has been deteriorating. I don't really have a lot to say on Ford, but I do want to point out the breakaway gap from the summer. A lot of people seem to think that all gaps need to be filled in. The reality is they don't. A lot of gaps do eventually get filled in, but it's the ones that don't that are the most significant ones, the most important ones, the ones that carry the most meaning. And that breakaway gap in Ford, I think that's going to be one for the technical analysis textbooks, because look at it. Ford had a powerful move higher from the end of May over the next 6-7 weeks. It peaked in early July, and when it peaked at 1525 and put in a perfect textbook double top right there at that 1525 level. And then the breakaway gap lower, and from 1525 to $11, a significant move lower in Ford. And even though Ford is having this auto worker strike and all this negative press. The stock is just consolidating down here at support near 11.75, but I wouldn't necessarily think of this as a bullish consolidation of a stock that is about to turn around and move back higher. I would say it is also guilty until proven innocent. But breakaway gaps, that's a very powerful example of a breakaway gap. Natural gas. So natural gas has had an incredible run. We've been pounding the table on this for more than a month. Nat gas got up to almost 350 at the peak last week. It's definitely pulled back about 10% off that high. I was long this from about 265, took profits, raised trailing stops on the way up. And at this point in the trade, you should either be out of the trade, having taken profits, or you should be holding a runner, like one final contract long, and have a very clear stop loss level. For me, the $3 level, which was the previous breakout level, that's going to be the new downside, support level. Something to also keep in mind about natural gas as far as near-term trades go, seasonality now transitions from a very favorable September, October to a less favorable final 2 months of the year. So seasonality starting to go from a tailwind to a headwind, and the chart showing signs of being a little fatigued and needs a reset. So let's see if it sets up again for another long trade. I don't think there's a hurry to jump in on this. Yeah, it's a volatile market, but let it set up a little bit. Let's see if it can continue to consolidate above that $3 level. A gold miner that I've talked about a few times in the last couple of months, IAM Gold IAG, had a very strong move off of that $2 support level the last couple of weeks. This is one I would continue to watch. I have it front and center on my gold miner watch list. The catalysts are still all in place here, and I'm looking at this one for an end of year trade into the new year, into Q1 2024, when they will be ramping up production at their Cote Lake gold mine project in Quebec, Canada. So definitely an important gold mining stock to watch, and that's showing some positive, favorable price action in the last couple of weeks. And I'll just wrap up with Hercules Silver. I'm not going to say anything groundbreaking about this, aside from the fact that big is the symbol on the venture, was one of the breakout charts in the junior mining space in the TSXV last week. You can see this powerful move. Company announced a new copper porphyry discovery on Tuesday morning, and that accounts for this gap higher up to 31 cents. From 31 cents, it traded all the way above 50 cents to finish the week. I'll be speaking with the CEO of Hercules Silver. His name is Chris Paul on Thursday at noon Eastern time. I'll share that link in the video here. And I'll just say that this is a pretty exciting story now. Obviously, we need to see a lot more drill holes. The company is drilling with 2 rigs. There's assays pending for a bunch of holes. But what got the market so excited was this news from last Tuesday: 185 meters of 0.84% copper, 111 ppm moly, and a little sprinkle of silver in there, including a higher grade portion, 45 meters of almost 2% copper. And the key bullet points sort of tell the story. Blind copper discovery. So this project had never been drilled to the depth that this hole was drilled to. And even they had to end the hole prematurely due to challenges with the drill rig. It ended in mineralization, so they were still hitting copper when the hole ended. They continued to do step out, drilling at the project, and they say it indicates the system extends considerably deeper. So open in all directions, blind discovery. And one of the main reasons why they drilled this hole 2305 was this IP chargeability, anomaly that's showing at depth. So you can see the historic drill holes never got down to this anomaly area, and you can see the scale bar here. Okay, so that's 500 meters. You can do the math. Okay, this is almost 2 kilometers across here, and the width is also pretty considerable. So it's exciting stuff. I'm not going to do it justice by talking about it right now at the end of my video, but I'll be speaking with Chris Paul, the CEO of Hercules Silver, Thursday at noon. So I hope you will turn into that one. I own this stock. I bought it Tuesday after they announced the discovery hole news. So it should be a really good conversation. If you have questions for Chris, please send them my way. So thanks a lot for your time again on this Monday morning. I hope you have a powerful trading week. And until next time, again, if you enjoyed this video, please like and subscribe to my channel.